Hi, I'm Blake Lively, and I'm going to be taking the BuzzFeed quiz, which iconic Blake Lively character?
Hey besties, welcome back. Today we are diving into something that honestly changes the way you might look at celebrity brands forever. Because what if the narrative we've been sold, the glossy interviews, the female-founded, the empowerment angle, isn't the full story? What if the company at the center of all this controversy wasn't exactly what it appeared to be from the outside? Let's talk structure. Let's talk money. Let's talk contracts. And most importantly, let's talk risk. When people hear the name of this beverage brand, they associate it with Blake Lively. That's intentional. The marketing has consistently leaned into the idea that this is her company, her vision, her entrepreneurial move into the beverage world. But corporate filings and deposition testimony paint a more layered picture. The entity behind the brand is a holding structure, Betty B Holdings, backed by multiple investment groups and LLCs. That includes investment entities, capital partners, affiliated companies, and talent management structures. In other words, this is not a one-person startup built from a kitchen table. It's a consortium. Blake and Ryan are involved, but they are not the only players. And more importantly, they are not the largest financial contributors. According to deposition excerpts that have circulated publicly, Blake and Ryan's affiliated company contributed approximately $2.1 million for roughly a 30 to 32% ownership stake. Meanwhile, another major investment entity reportedly contributed around $15 million for a smaller percentage share. That significant. It tells us something very important: the celebrity value, their faces, their branding power, was treated as a form of capital. In other words, their image was monetized as equity. That's not unusual in celebrity business deals. In fact, it's common. Aviation Gin, Mint Mobile, and similar ventures have followed this model. Celebrity comes in, lends brand recognition, marketing amplifies awareness, larger company acquires, payout structured heavily in stock and performance incentives. But here's where it gets interesting: the company reportedly includes a morality clause. And morality clauses in celebrity contracts are not minor technicalities, they are risk management tools. The language, as described in deposition testimony, suggests that if a public scandal significantly damages reputation, even if no crime is committed, the board could vote to remove a talent manager from their role. Importantly, that vote would exclude the talent themselves. Let's pause there. This doesn't require criminal conduct. It doesn't require illegal activity. The standard referenced in the contract language appears to involve publication in major media outlets and a material adverse impact on public image. In corporate terms, reputation is an asset, and if that asset becomes a liability, Boards Act. Now consider the timeline. The non-alcoholic line launched first. Alcohol products were reportedly introduced later, around 2023. Financial projections were ambitious. Internal projections suggested aggressive case sales growth. But deposition testimony indicates actual performance fell below projections significantly. For example, one cited projection aimed for approximately 200,000 cases. Reported numbers suggested closer to 125,000. That gap matters because early-stage beverage brands operate on razor-thin margins. Scaling requires enormous capital, distribution, shelf placement, promotional spend, logistics. Competing against dominant premium mixer brands with significantly larger budgets is not easy. In deposition exchanges, when asked whether lower performance was attributable to a short-term publicity issue, the response reportedly indicated that growth challenges predated any alleged smear campaign. That is key. If revenue softness existed before controversy, then attributing all financial underperformance to reputational harm becomes complicated. Now, let's talk profitability. Public discussion of financial disclosures indicates negative net income in both 2023 and 2024, particularly after the alcohol line launch required additional capital infusion. One figure referenced approximately negative $446,000 in 2023. Another referenced losses exceeding $3 million in 2024 following expansion. Startups lose money early. That alone is not scandalous, but the narrative being publicly debated involves claims of reputational damage and business harm. If a company was already operating at a loss during scale-up, establishing causation becomes more legally complex. This brings us back to motive. When celebrity-backed brands aim for acquisition, the strategy often involves proving traction, enough case volume to attract a larger beverage conglomerate. the celebrity face is central to that valuation. The face is the product multiplier. If that face becomes polarizing, controversial, or associated with sustained negative press, acquisition attractiveness changes. That's not moral judgment, that's valuation math. In similar deals, the celebrity typically does not walk away with immediate billions. Most headline numbers reflect total deal value, heavily weighted in stock and performance earnouts. Payouts depend on future performance benchmarks. When media headlines claim billion-dollar acquisitions, the liquidity reality is often far more nuanced. Now here's where critics raise eyebrows. Marketing for the beverage brand reportedly intersected with film promotion timelines. Observers questioned whether cross-promotion blurred messaging. Critics argued that certain product naming or branding choices were tone-deaf in the context of a film addressing serious subject matter. Supporters argue that cross-promotion is common business practice. The question is not whether cross-promotion exists, it's whether it was strategically wise and if public backlash occurred. Boards evaluate risk. Remember the morality clause. If a board believes reputational harm occurred, regardless of fault, they have fiduciary duty to investors. A fiduciary duty does not operate on vibes. It operates on shareholder value. This is why lawsuits in these contexts often become high stakes. Not simply because of personal offense, but because of contractual exposure. If reputational damage triggers removal clauses or investor disputes, litigation becomes not just personal, but financial survival. Now let's address ownership perception. Public messaging often framed the brand as woman-owned or female-led. Yet filings show a board composition including multiple male executives and investors. That's not uncommon in venture-backed startups. But it complicates branding narratives. If consumers believe they're supporting a founder-led independent company, and the structure reveals led investment vehicles, perception shifts again. Not illegal, not unusual, but different from branding shorthand. Another interesting point raised in deposition discussion: incentive units tied to performance. Marketing partners and affiliated companies reportedly had financial upside tied to growth metrics. That creates internal pressure when projections are missed and scale is slower than anticipated. Strategic pivots happen. In one exchange, there was mention of possibly phasing out or restructuring certain segments if profitability did not improve. 3 years without breaking into top-tier market share is significant in beverage retail. Dominant brands in premium mixers control substantial shelf space. Without distribution muscle or aggressive promotional budgets, growth stalls. When critics suggest the brand struggles were entirely due to short-term negative press, the financial timeline suggests performance challenges may have existed earlier. Now, does that mean reputational events had zero impact? Not necessarily. Brand perception matters in consumer goods. Even minor controversies can affect velocity, but proving that a specific alleged smear campaign caused millions in losses requires isolating variables in a complex market environment. Investors will look at historical growth trajectory, pre-controversy sales trends, competitive market share, distribution expansion timing, and capital infusion patterns. If losses predate controversy, causation arguments face scrutiny. This brings us to the broader pattern Ryan Reynolds has successfully leveraged. Celebrity equity. Before Aviation Gin and Mint Mobile followed the celebrity as value model. Marketing amplification through maximum effort became a signature approach. When it works brilliantly. But not every brand scales identically. Every product category has different competitive density, capital demands, and consumer behavior. Attempting to replicate a formula does not guarantee identical outcomes, and when outcomes diverge from projections, legal blame can become part of strategic defense. Some analysts suggest that aggressive litigation may serve dual purposes: defending personal reputation and signaling to investors that reputational harm was externally caused, because if reputational decline is deemed self-inflicted or strategic miscalculation, contractual consequences differ. If it's externally inflicted through defamatory action, that shifts liability narrative. Again, these are interpretations, not findings. What is clear from deposition excerpts is that company leadership acknowledged lower than projected sales and difficulty eroding dominant competitors. Market share. It's also clear that celebrity ownership was partial, not majority, and it's clear that reputational clauses existed to protect investor value. So the central tension becomes this: was the brand harmed primarily by external smear campaigns, or was it struggling to achieve projected growth regardless? That question likely sits at the heart of ongoing legal battles. Because if a company is valued largely on celebrity image, and that image becomes contested, the financial dominoes can Fall quickly. Celebrity equity is volatile. Equity.it rises fast. It falls fast, and when tens of millions in investor capital are involved, nobody shrugs off volatility. Now, zoom out. Public perception often assumes celebrity couples are liquid billionaires. Headlines inflate valuation numbers. Stock-based payouts get misinterpreted as cash, but when you examine deal structures, performance contingencies dominate. Equity tied to future metrics isn't guaranteed wealth, it's leveraged potential, and leveraged potential is vulnerable to reputational swings. So are these companies broke? That word is dramatic. What filings suggest is early-stage losses, underperformance relative to projections, and heavy reliance on celebrity brand power to drive scale. That's very different from a profitable enterprise humming along disrupted only by scandal. The financial narrative appears more complex. As litigation continues, discovery may clarify whether reputational harm materially altered trajectory, or whether trajectory was already flattening. For now, what we can say based on public testimony and filings is this: the company structure is layered and investor-backed. Celebrity ownership is significant but not majority. Capital contribution performance lagged projections before alleged smear events. Morality clauses create reputational risk. Exposure losses were reported in consecutive years during expansion. Those facts matter because when lawsuits seek damages tied to brand value and future projections, courts examine baseline health, and baseline health appears, at minimum, challenged. We're going to continue unpacking how this ties into the broader legal strategy, investor exposure, and what happens if boards decide reputational risk outweighs celebrity upside. That's where things could get explosive. Alright besties, let's pick up exactly where we left off, because this is where the conversation shifts from business structure to legal survival. If part 1 was about how the company is built, part 2 is about what happens when that structure is put under stress. Because here's the uncomfortable reality about celebrity-backed companies: when your face is the valuation, your reputation becomes collateral. And collateral can be called in now. Let's think strategically for a moment. When a company is investor-backed, layered with holding entities, performance incentives, marketing agreements, and morality clauses, every executive and board member has one overriding obligation: protect shareholder value, and not protect feelings, not protect public image for PR purposes. Protect shareholder value. If projected growth doesn't materialize, and if reputational events coincide with that slowdown, lawyers start mapping exposure immediately. And here's why this matters. If a celebrity's contract includes a clause stating that significant reputational harm, particularly harm documented in major media outlets, can trigger removal or board action, then litigation becomes more than personal vindication. It becomes a defensive maneuver, because if reputational damage is framed as self-inflicted, boards may have contractual grounds to act. If reputational damage is framed as externally manufactured, through defamation, smear campaigns, or orchestrated narratives, then liability shifts outward. That distinction changes everything. Now, let's zoom in on damages. When someone sues for reputational harm tied to business loss, they must show causation. Not just correlation. Not just bad timing. Causation. That means proving that but for the alleged smear, the company would have hit projections, scaled distribution, secured acquisition interest, or avoided investor hesitation. And this is where financial records become central. If deposition testimony indicates that growth had plateaued, that market penetration stalled at a specific percentage, that competitor brands retained dominant share, and that internal projections had already been revised downward, that becomes part of the evidentiary puzzle. Courts look at trend lines. Were sales declining before controversy? Was capital infusion already necessary? Were projections missed prior to negative press cycles? If the answer to those questions is yes, the defense argument strengthens. The trajectory was already compromised, and that's not a moral judgment. That's analytics. Now let's talk about investor psychology. When venture-style investors commit millions, like the reported $15 million contribution from a major holding entity, they are betting on scalability and exit. Exit is the goal. Typically, the exit strategy for celebrity beverage brands is acquisition by a larger conglomerate. The conglomerate buys brand recognition, market foothold, and celebrity endorsement power. But acquisitions require confidence in durability. If brand durability is tied to an individual whose public image becomes polarizing or unpredictable, acquisition multiples shrink. Investors know this. So if reputational volatility increases, investors may hesitate, renegotiate, or delay. Now imagine being the celebrity whose image anchors that valuation. If you believe negative narratives artificially, Suppressed acquisition potential. Litigation becomes leverage not just for damages, but for signaling. Lawsuits can serve as public declarations. The damage done to this brand was not organic. It was inflicted. That message is as much for investors as it is for courts, because investor confidence often hinges on narrative control. Now, let's talk about performance-based deal structures, because this is another layer people often misunderstand. In celebrity acquisitions like Mint Mobile or Aviation Gin, large headline numbers get published. Billion-dollar valuations. Massive acquisition headlines, but the fine print matters. Much of that payout is structured in stock, much of it is contingent on performance benchmarks, much of it is staggered over time. That means the celebrity's long-term payout depends on continued brand success under new ownership. So if a brand fails to scale before acquisition, or fails to maintain velocity afterward, the theoretical payout shrinks. In this beverage case, if scaling never reached critical mass, acquisition leverage weakens, and if acquisition was the intended exit strategy, prolonged underperformance becomes a ticking clock. Now layer on public controversy. Even if controversy didn't start the financial decline, it can accelerate investor anxiety, and anxiety triggers legal positioning. Here's another angle: board dynamics. When a company has multiple stakeholders, investment funds, marketing partners, affiliated entities, internal tensions can rise when projections fail. Who's responsible? Was it distribution? Strategy? Was it pricing? Was it market saturation? Was it messaging? Was it brand positioning? Or was it reputational miscalculation? Assigning responsibility determines financial liability and future control. If a board believes reputational risk created material harm, they have options under contractual governance. Those options may include renegotiation, removal, restructuring, or dilution. And that's where stakes become deeply personal, because if your equity stake is 30 to 32% and the company restructures, your influence changes. If additional capital is raised at lower valuation, dilution occurs. If investors lose patience, forced strategic pivots happen. So when critics suggest that litigation is purely emotional, they may be missing the financial chessboard underneath. Litigation can free certain board actions. It can buy time. It can reposition blame externally. It can create negotiation leverage. That does not mean claims lack merit. It means legal strategy often serves multiple objectives simultaneously. And now let's revisit the woman-owned branding narrative. Public marketing emphasized empowerment themes. Female entrepreneurship. Independent vision, yet corporate structure shows a network of investors, many male executives, marketing entities connected to the celebrity spouse, and capital contributors with significant influence. That discrepancy is not inherently improper, but it creates vulnerability if consumers perceive mismatch between branding and governance. Consumer trust is fragile. If public debate shifts from product quality to corporate authenticity, brand momentum stalls, and stalled momentum in beverage retail is brutal. Shelf space is competitive. Retailers track velocity weekly. Underperforming SKUs get replaced. If sales dip below thresholds, retailers reduce orders. Reduced orders lower production efficiency. Lower efficiency increases cost per unit. Margins tighten further. It becomes a feedback loop. Now imagine navigating that environment while headlines swirl. Even if controversy is not the root cause, it becomes noise that distracts from execution. Investors notice distraction. Now let's consider worst-case scenarios. If litigation fails to prove material reputational sabotage, and if financial underperformance is documented as pre-existing, plaintiffs face credibility challenges. If boards then reassess leadership value, contract clauses may activate. If investors claim breach of duty to protect brand image, counterclaims could theoretically emerge. That is speculative, but structurally possible under certain agreements. This is why high-profile litigation in business contexts often feels existential, because it is careers. Equity. Investor trust. Future acquisition deals, all intertwined. Now, let's address perception versus liquidity. Public lifestyle imagery suggests immense wealth. Private jets. Luxury properties. High-profile investments, but liquidity differs from net worth estimates. Stock-based valuations fluctuate. Performance earnouts remain contingent. Startup equity tied to loss-generating ventures does not equal cash flow. So when commentators debate whether someone is broke, the more precise framing is this: are certain ventures currently generating sustainable profit? Reported losses suggest challenges. That doesn't equate to insolvency, but it does undermine billion-dollar optics, and optics matter. because optics feed brand value. Now here's the final layer. If this lawsuit succeeds, if a court determines that reputational harm was externally inflicted and materially damaged business value, it reinforces narrative control and may strengthen investor confidence. If it fails, if causation cannot be established, internal corporate consequences may follow. Either outcome reshapes the business landscape around this celebrity brand ecosystem, and remember, the beverage brand is only one piece. There are licensing agreements, other product lines, marketing affiliations, future ventures. Reputation functions as the umbrella over all of it. If the umbrella tears, rain hits everything underneath. So what are we really watching? Not just a feud, not just a press battle, not just a marketing misfire. We are watching a high-stakes negotiation over narrative ownership and financial accountability. Was the brand trajectory derailed by malicious external forces, or was it an ambitious projection that collided with market reality? That is the question courts and investors ultimately care about, because in the end, litigation may determine not only damages, but whether celebrity equity remains an appreciating asset or becomes a depreciating liability. And that's why this fight feels so intense. It's not just about headlines. It's about leverage. It's about control. It's about protecting millions in investor capital. And it's about whether a brand built on image can survive when the image becomes contested. Now I want to know your thoughts. When you look at the structure, the reported losses, the morality clauses, and the litigation strategy, do you see a defensive move to protect investor relationships? Or do you believe reputational sabotage genuinely altered the company's path? Because this isn't simple. It's layered. It's strategic, and it's far from over. We'll keep watching the filings.